Our next guest says investor sentiment has shifted from abject fear and loathing to something a bit warmer. I don't know whether that's good or bad. Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. As soon as everyone started feeling better about the markets, the market had stopped going up. Savita.
That's typically how it works, Joe. So, I think we're still in a spot, though, where there is tremendous skepticism around the ability of risk assets to, continue to move higher. Our view is that stocks still look a lot better than bonds. And I think that that's where we're the most out of consensus, because I think, folks around us see, 4+% yields and think, okay, this is a great trade. The risks around stocks versus 4% in the bag. I think the opportunity cost is high of locking in low rates for the next, 10 years. Here's our view. I think rates could move higher. I think that we're in an environment where the demand for treasuries has evaporated and all the buyers have flipped to sellers, namely the Fed, China, Japan. Global demand for treasuries has shifted from hot to cold. And when you look at stocks, I think what's interesting about stocks is that they're doing all the right things. So what makes me really happy about the private sector and corporates and consumers is that we all learned our lesson during 2008, 2009, that floating rate risk is bad and you want to lock in low debt if you have debt at all. And I think what's really great today is that consumer and corporate balance sheets are actually still very healthy, given the amount of inflation we've had to shoulder, et cetera. So, I don't know. I think it's one of those environments where we're looking at 2008, 2009 and bracing for the end of the world. And it's actually a very different setup today.
We've been, I guess you've been watching the show. We keep having that discussion about 4% for 10 years versus, I don't know, if you got a good company with a dividend and it's growing at a X amount per year, then you've got all the potential upside of the company, being well managed and run effectively, and dividend increases, which gets you to.
Who's got 4%? Maybe Savita, where can I get a 4% dividend yield?
You don't have to get it now. Saying you buy a 2.5% yield now, and it goes up 15% a year over the next 10 years. That dividend yield is going to be up it probably double digits, and you also get the appreciation. The best you're going to get on the 10-year is your principal back. Probably eaten away by inflation because 4% and taxes because 4% won't be enough.
I love it. I think we're very like-minded this morning because, to your point, I think you can actually get higher free cash flow from energy companies. If you look at energy versus tips, right? Like everyone's worried about inflation-protected income. Energy versus tips, the free cash flow differential is 9 percentage points. So I think that we're in an environment where there are still dirt cheap stocks that aren't necessarily discounting a healthier environment. Meanwhile, all the economists on Wall Street have dialed back their recession forecast, or most of them have, and we're looking at consumer spending still strong. Pockets of the consumer, landscape are starting to weaken, but it's mostly in services where, we can't spend any money on travel because we're all going back to school. So I think that, we're in a pretty good spot, and there are not enough people cheering about how good the economy looks and how the Fed has actually done us a huge favor by getting us off of zero, up to 4.5–5% on the short end.
So I think you're not going to build wealth at 4%. Nobody's ever built wealth in anything other than the stock market. Ron Barron messaged me. He goes,
totally fair. That's totally fair.
You'll get your money back, maybe not eaten away by inflation.
Here's the XLE, Savita, for what it's worth. Okay, 3.7% dividend yield. But, the past 5 years, the price has gone from 70 to 87. Okay, it's okay, but there's going to be
Nobody's ever gotten rich investing, just getting your principal back. Hopefully not even.
It's not a get-rich thing. It's just
what else are we?
Market timing.
Make sure your money, you get your money.
Market timing.
So you put it on their mattress, you do even worse. But you do a little better in your 10-year 4%. But people only become Warren Buffett or Ron Baird. Take your pick.
If you take
all these people that have become wealthy from being smart enough to.
This is not a 401k.
You don't even have to be that smart. When the market goes from 800 in 1981 to 35,000, you don't even have to be that smart. You just be in it. To win it, you got to be in it.
I think you got to be in it, and I think that you got to be in the right stuff. So I don't love the cap-weighted S&P 500 here. I think what looks more interesting is the equal-weighted benchmark. And, I think we talked about this last time I was on the show, but if you look at performance since May, or since end of May, the equal-weighted benchmark has actually outperformed the cap-weighted benchmark. So I think there's something going on underneath the surface of the U.S. stock market, which is a broadening out, the idea that not all these companies are going to go to zero and you just want to own 7 tech companies. There is a real, strong reason to own a broader market portfolio today. I think the other important factor that we've noticed during earnings season is that you've had companies tell us that they're spending on efficiency and they're actually starting to reap some of those benefits. So if you look at productivity, it jumped in the second quarter. If you look at labor efficiency, companies are dealing with high wage pressure, but they're doing the right thing. They're thinking about how to get leaner, how to get more efficient. And longer term, what we've found is that investors are willing to pay a much higher multiple for companies focused on efficiency than companies that are just earning money from buying back their shares. Right. So I think we're in a great spot right now. I actually feel more positive on corporate America than I have in years because companies are thinking about how to handle a higher hurdle rate, and they're doing the right things. They're cutting costs. They're getting efficient. They're thinking about where they can, use AI. I don't think AI is the panacea, but it's part of this larger efficiency story that makes me more bullish on corporates.